Let's have a look at how the secondary markets division is set up. If you think banks or investment banks are places where everybody makes loads of money, you'd be very mistaken, because the vast majority of people are actually in support functions. The ratio of a profit center, somebody who actually brings money into the company, and somebody who's a cost center, for every one person that's a profit center, 4 people are a cost center. There's 4 in support. And the secondary market side kind of works like an upside-down pyramid model. The traders hold everything up. The traders are still the most important people. They're in control of the bank's balance sheet. They're the gatekeepers of the bank's balance sheet. What they say happens. So what you see at the top is actually what's right at the bottom, the support function. So we've got support, technology, compliance, and operations. Typically, a global secondary markets business at a top investment bank will have about 3,000 of these people. They don't bring any money into the company. They're a cost center, and they're viewed internally as a cost center. They get the least pay. The first profit center, and I'm going to use the term loosely here, is research analysts, the guys that write the proprietary research or the bank's research on the assets, on publicly traded assets. I'm using the term loosely because increasingly they're less and less and less of a profit center because the old business model is now dead. The old business model was pension funds and hedge funds used to pay for research. They used to pay directly for research. They don't anymore. They then used to pay for research in the execution business via commissions. But they can execute everything themselves now, and they've got their own in-house research. So they don't pay for research anymore. There's still a few figurehead research analysts knocking about on Wall Street and in the city who still get paid okay, but the vast majority get paid nothing. Basic salary and a small bonus, because that side of the business is dead. They bring very little money into the company anymore. The first real profit center is in sales, and that's hedge fund sales, not long-only sales, because long-only sales rely on the research business model. There's only a couple of them left at each investment bank. They've all gone. Why? Because there's no opportunity to make money. They don't get paid. Hedge fund sales, they're the first real profit center on the secondary market side, because what they're doing every day is speaking to the hedge funds, and they're coming up or generating trade ideas, and the hedge funds are more active. So the opportunity to be there to make money still exists, but it's still down massively versus 10 years ago. That it's right to call them a profit center because they bring money into the firm. So a guy comes up with an idea as a hedge fund sales guy. They put the trade idea into the hedge fund. The hedge fund decides they want to do it. Naturally, through the execution business, commission is paid. So they can add incremental dollars to the business. The next profit center, and it's a supposed profit center, is the sales trading function. Sales traders are part of the execution team, the execution business, and they sit opposite or amongst the traders. And they're speaking to the dealers at the pension funds and the hedge funds. So when, in that example, the Apple example, the $10 million example, when the pension fund manager decides they want to top up their portfolio in Apple and they want to buy $10 million, they call internally or send the order down to their dealer internally at the pension fund. The dealer then sends it to the sales trader. The sales trading function is very defunct compared to what it used to be, because it used to be on a relationship basis and also on a paid research basis, because the pension funds and the hedge funds the pension funds and the hedge funds were paying for the research. So they'd get lots of business coming through. And they used to be able to add incremental value to the business. They can't now. So they now get paid very little. So imagine the situation where the dealer at the pension fund calls the sales trader picks up the telephone, and the dealer says, I want to buy 20,000 Apple at $500. Sales trader says, okay, clicks the back of the phone, puts it on mute, and asks the trader. The trader decides. If the trader says yes, he clicks the back of the phone and says, yes, you can buy 20,000 shares in Apple at 500, and they put the phone down. Really, the sales trading function in the noughties, or the late 90s noughties, was a rebrand for the term order clock. Someone who takes the orders. But how do you think the traders view the sales traders in a business sense? Well, when the trader wants to do something, they advertise it. So when the trader wants to short $10 million of Apple, that can be advertised. It can actually be advertised directly to the clients via software, so it bypasses the sales traders, but somebody still has to be there to pick up the telephone. So when the trader wants to do something, they view the sales traders as distribution. So they empower the sales traders to go out and bring business into the company. But really, they're just an extension of what the trader wants to do. So it's the trader who's really bringing in the money. Now think back to those numbers where commission's down 80%, proprietary trading is down 80%, bonuses are down 80%. That's the traders. That's in the last decade. That's the traders, and they're the most important people on the trading floor. Everyone has to speak to the trader. If you want to know something, you have to go through the trader at some point. They're the guys, they're the glue that holds everything together at the investment bank. What do you think the rest of the guys get paid? It's worse. The trader is the best career opportunity at the investment bank, still. But it's down 80%. So when you get the corporates coming in, investment banks coming in and saying, we've got a great program in the technology compliance and operations department that you should be joining as a graduate, you need to be asking them some serious questions, because all those guys rely on the commission business and they don't bring money into the firm. And if that business is in structural decline and continues to be, it's finished. You don't have a career opportunity. You need to understand this. This is what they're not going to tell you.